Hello and welcome to Switzer Investing. I'm Peter Switzer, and for our special long weekend show, I've asked my expert colleagues to give us the stocks they want to add to their portfolios and the ones they will or would dump if they were holding them. My expert adders and dumpers are Julia Lee of Berman Invest, Junbei Liu of Tribeca Investment Partners, Paul Rickard of the Switzer Report, and then I will share my views with you on the subject. And finally, I've got Michael Gable of Fairmont Equities to do the charts for most of these stocks. I want to know whether the charts are saying, yes, these people are right, or no, these people are wrong. So without any further ado, let's cross to Julia Lee of Berman Invest. Well, joining us first up, as she always does, is Julia Lee of Berman Invest. And today we've got the two unusual questions. What is the stock she wants to either add to her portfolio or bring into her portfolio? And on the flip side, what is the stock she would dump if she's already got it, or if she was holding it, she would want to dump? It's a good story and a bad story. Julia Lee, take it away.
Well, let's start off with the good. I'm going to concentrate on a company called ALS. The stock code is ALQ. This is one of the world's largest testing companies in the world. So it's a very diverse business, but its two biggest areas are life science as well as the minerals area. And in the area of the minerals, well, we know that miners, commodities have been performing quite well. And in fact, the lead indicators in this area are good. And really, when you're looking at lead indicators for this sector and for testing, you're looking for money raised. So whether that's through lenders or whether that's through equity capital, you're looking for total financing by these miners as a lead indicator for ALS's mineral sector. And the good news is not only has it been good, but it's actually accelerating. So in August, it was up 44% year on year. And the meters drilled by miners is back to pre-COVID-19 levels. And I'm a big believer that we will see commodities doing well on the back of stimulus spend and infrastructure spend post the COVID-19 situation. In particular, we know that gold exploration is also running quite strong. That should be good news for ALS. And the other area we're watching, of course, is the life sciences, which is its other major revenue centre. And in this area, there's also tailwinds happening. We've got Brexit on the horizon now. Yeah. And this is really going to mean that things are going to be tested both ways. So coming out of the UK into Europe and out of Europe into the UK. So a double whammy for ALS.
And Julia, do they make anything, or is it all service provision?
It's all testing. So they're testing in the area of industrials, commodities, miners, food sciences. They're testing surfaces for COVID-19. So it's one of the world's largest testing organizations. And as you can imagine, they're pretty much in any sector you can imagine.
And I reckon, I need to research it, but they're a company that could easily benefit from the budget where the government is promising to spend about $1.8 billion to encourage manufacturing. And one of the sectors was the area of minerals and food and beverage. So if there's investment by those companies, they would probably use the services of ALS.
Absolutely. And look, it's a global company, so let's hope that the whole world does that. But that $1.8 billion pre-budget announcement certainly is an interesting one here for Australia. So just having a look at which manufacturing companies may have a bit of an edge and be able to attract some of that government funding.
Yeah, without doubt. Okay, Julia, now give us a stock that you're not so keen on.
Could I give two?
Yeah, of course you can. Fire away.
Let's start off with Blackmores. Now, Blackmores is a vitamin and health company. And look, its major growth area is China. But unfortunately, because of the lack of international travel, it means that its Daigou market, which is a major sales channel, has been under pressure. Now, the Daigou market is where travellers to Australia or students studying in Australia buy goods and ship them back to China for sale. And they do that through WeChat or through other communication services. So that channel has been under a lot of pressure, and we've seen that type of commentary coming through from A2 Milk as well. But the problem with Blackmores is that it still doesn't have SAMR, or it doesn't have product registration over in China, which means that for the last year, what it's been searching for is a partner in China to try and grow its brand and business in China. But unfortunately, it hasn't managed to do that. So it's still hunting. And unfortunately, it's very vulnerable to the COVID-19 situation, despite, logical thinking being that you'd probably want to buy more vitamins.
Yeah.
If you're worried about your health during COVID-19. But I think Blackmores will continue to be under pressure here. The other stock that I've been watching very closely is Computershare. Look, the last results weren't too bad, but the forward guidance they were giving was quite soft. And it now looks like things are going to get a bit more difficult for Computershare. Now, Computershare offers products and services to listed and unlisted companies. And basically, they hold billions and billions of dollars of cash on behalf of their clients and on behalf of unit holders and shareholders. A lot of that money just sits there waiting to be paid out in dividends or waiting to be issued in the form of shares. But while that cash is waiting, Computershare earns interest on that cash. Look, with interest rates here in Australia now forecast to go down further over the next couple of months, unfortunately, a soft outlook for the current financial year may turn out to be an even softer one, with interest rates falling here in Australia and staying very low in the rest of the world, especially the US, which is also a key way that Computershare gets its interest income for the next few years. So look, I'd probably be steering clear of Computershare.
Okay, given that, does it make you feel a bit negative towards Link as well?
Yeah, look, Link is in the same type of circumstance as Computershare in that it does, earn money in terms of the accounts and the cash that it holds. But I guess in terms of valuations, Computershare trades at a bit of a premium to Link. So that's why I'm probably a bit more negative on Computershare than Link. And Link has a higher degree of exposure to the European markets rather than the US and Australia.
Okay, Julia Lee, as always, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, we are looking at the stocks that our experts would like to own more of and those stocks they would like to dump. So I've got Paul Rickard of the Switzer Report to give us the 2 or 3 that he wants to either keep or dump. Paul, let's go with the positive first.
Well, I double up, Peter, so I'll give you 2 I like. One is Xero, but that's a buy in the dip stock. So
it's currently too high for you.
Too high for me. The other one is Lend Lease, Peter, which is a bit out of favour. It's down around about $11. The analysts think it's worth almost $14. I like Lend Lease because it's now really focusing on development, and I think its strategy about looking at major projects, urbanisation projects in some what they call the big marquee cities. I still think that's going to have merit post the pandemic. It doesn't necessarily mean building stuff in the middle of the city. Yeah. It means really building developments around a whole lot of things. Not just aged care, but also residential care and low income housing and all sorts of affordable housing. As sort of marquee suburbs in marquee cities.
Have they shown any interest in the idea of building to rent? So they're doing some of that as well. Yeah. So, and of course, there's sort of 3 tiers to their business. Construction's the smallest part, that's probably the riskiest. Yeah. But that's what you see around places like Sydney, particularly with the cranes, and in Melbourne and so forth. But construction's the smallest part, development's the major part of the business, and then financial services, which comes from really funds management. Yeah. They'd like to get a piece of each where they can, and I think the strategy makes a lot of sense. So, look, it's a stock that I don't think is going to do much in the short term. Yeah. But you're buying it at a low, aren't you?
I'm buying it at a low, and I think it's one to lock away. It's have a look at the strategy paper. They've done a recent presentation about outlines their strategy. It's one to believe in. I think you've got to sometimes back management. You've got to back the vision of the company. I think there's a vision there for that company.
Yeah. Okay, let's go to the ones that you don't, or the one that you don't like.
Look, the one I don't like most is Tabcorp. Look, it's probably got cheap enough, but look, Tabcorp is a stock that I paid $2.57 when TAB, New South Wales TAB, was floated all those years ago, and today it's still trading around about $3.40, $3.45.
Small gains.
Tiny gains. The dividend's been pretty ordinary. The reason I don't like the company, and look, there is new management coming in, so that might save it. But look, it's comprehensively got licked in the wagering space. All these other online bookmakers came in and stole its thunder, so it missed the whole online move far too late. And then secondly, it bought a fantastic company in Tats, which is sort of the e-gaming and the lotteries business. Decided it didn't need any of the Tats personnel. Tabcorp knew best. Hasn't done a particularly good integration. The board is weak. The CEO's on the way out. Look, maybe that'll save the company, but it's a perennial underperformer.
Paul Rickard from the Switzer Report. Well, for our long weekend show, we are looking for the stocks that our experts would love to hold or add to their portfolio, or the stocks they'd like to dump if they got them, or they wouldn't consider buying because they just don't like those stocks. And my next guest is June Liu. She's in her location and I'm in a car. Well, it is a long weekend. And Switzer will pursue information about stocks wherever he goes. June Liu, how are you?
I am fantastic. You're absolutely right. Stock market never sleeps. And we talk about stock anywhere and everywhere.
Exactly right. So June Liu, let's kick off with the first one that you really like. You'd add more if you've already got it.
Look, we really like Zip at this point. The company has been doing very well. However, the share price has lagged other buy now, pay later player. And we can see there's a catalyst coming up in the next 9 days. The company will give an update on how things are tracking. And from everything we can see, that update is going to be very strong. So even tactically, this company, you should definitely have it in your portfolio.
Okay. So is there any other one that you would add to your portfolio that you like right now?
Absolutely. Look, we see plenty of interesting companies to add. One of the names I would add at this point is Center Group. I really believe that this reopening theme, as the shops does open up, as people are allowed to go to the shopping centers, the valuation of the company will start to rise. And this company is still very, very cheap and has been left behind by the market. Okay, let's go to the stock or stocks that you really don't like and you would run a mile if someone tried to make you buy them. Look, number one, it will be AMP. The company looks cheap and like there's possibility for separation, but our view is that it is way too early to call the stabilization of its earnings. Recently they announced the cuts to the staff numbers so that they can stabilize the cost base, but we don't know what the revenue may even look like in the next 12 months. I just think it's way too early to be looking at this business, and the actual separation of the assets is going to be very difficult as well. So way too early for that business. Wouldn't touch it.
Okay, is there another stock you give the big thumbs down?
Oh, there's plenty of them. I think at this point, if you look at some of the travel agents, they have done incredibly well. It is leveraged to that reopening theme, but for some of the travel agents, we do feel it's rallied very hard ahead of what the recovery might look like, which could be quite some time away. Relatively, we would much rather to play the likes of Sydney Airport or the Qantas on that basis. Much better managed business with very premium assets.
So therefore, stocks like Webjet and Flight Centre, they're not on your radar screen right now?
They're too early. They're way too early. And they have done quite well if you look at the share price performance in the last couple of months. So a lot of good news has been priced in. And the road to recovery is going to be a long one. Don't forget that.
Okay. June Liu, you have a great long weekend. Thanks for joining us.
You too. Thank you very much.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
For my part, I'm going to cheat. The stocks I want to add to my portfolio are what I call the ZEET stocks. That's Zip, Elmo Software, EML Payments, and Tyro. Now, I think Tyro and Zip have done really, really well. But if they dipped, I would buy more of them because I think that futuristically they're going to do very well. And I think Elmo Software and EML Payments are two companies that will really do well as the economy opens up more and more and we come closer towards normalcy. So I like those four stocks. I think Elmo and EML will do much better in the second half of 2021, but I have no problem buying them now. And the other two, I'd buy them on dips, but I think they're going to do very well. Tyro in particular, once Victoria opens up, Tyro's position in the hospitality sector, when we go into a pub or a cafe and we put a little credit card on the side of one of those little FPOS machines, that's Tyro, and they've got a fairly significant chunk of the hospitality market. So when Melbourne opens up, it will help Tyro as well, but I think it will grow over time. So they're the stocks I want to keep or even add to. The one I'm not keen to hold, and I've actually got it in my portfolio, bought it at very low prices, that's Virgin Money. The ticker code is VUK. We bought it because the price was low. It went up a bit higher. It's come back off. The UK is looking messy. It's got Brexit. It's got problems with second wave infections. I'd rather take that money out and buy even a bank like Westpac or even CBA. CBA is priced to perfection compared to the other banks. But I think as the economy gets better and normalcy returns, all big four banks will do well. I just think that Westpac is probably the one that will catch up the most because it's only around $17. But CBA would still be a good investment because it tends to lead the other three very, very effectively. As a part of the show, I got Michael Gable from Fairmont Equities, my charts guy, to look at some of the stocks that were supported and the stocks that our experts wanted to dump to see what the charts are saying about their speculations. Mike, thanks for joining us.
Thanks, Peter.
Let's not muck around. It's a long weekend, so looming anyway. Let's kick off with the one that Julia liked, ALQ. What's the chart say for that?
Look, it's a really good looking chart. I mean, at the end of the day, this stock's in an uptrend and it does look like it will continue higher. So the chart I've provided, I've put a couple of arrows there to indicate this double bottom within the uptrend, which is always a positive sign. It tells us that the stock does want to head higher. If I was to buy it here, what I always think about is the risk reward. So what I'm looking at is where the stock is now. The previous peak is only about 60 cents away, yet the support level where that double bottom was about $1.40 away. So about 90 cents away. So what that's telling me is, the risk reward to ratio is not ideal. So what I'd rather do is if this one came back towards that 850 level, that would be a really good buy point. Otherwise, if it broke through that February high, then we know we don't have any resistance ahead of us.
Okay, so
and then it
definitely
can
a
continue
buy
on
on the dip type stock.
Yeah, exactly.
All right, let's go next one, Tyro, Tyr. Poor Rickard liked this. And actually, now I liked it, I think. Yeah.
Look, this is a really good-looking chart, to be honest. So to walk you through it, what we saw was a really nice rally off the March lows. It got close to the February high, and then it's eased back. Of course, naturally, there's people trying to get their money back who bought in February, but it hasn't been sold off too sharply. And what I've indicated with these diagonal lines is the tightening of the range, and that's a real positive. So all we need to see now is the stock finally break above that diagonal line at the top, and then it will go for a rally, and I think it will surpass the February high if it can make a breakout. But the chances are, looking at this thing, I think we're pretty close to seeing it make a move.
The stock that Junbei Liu liked was Zip. And what are you seeing for Zip?
Look, this is also a great looking chart, to be honest. I mean, I'd be buying this one today. We can see it's rallied very strongly off the March lows. Like most of these buy now, pay later companies, it rallied a little bit too hard there in August, and it's had a bit of heat come out of it. But all it's done is go back to where it started, that very strong rally in August, and it's found some very good support there. Price action the last few days is telling me that this thing's going to continue to rally. So I think today is a buying opportunity for Zip.
Great. All right, Lend-Lease, this was Paul Rickard's.
Look, I can't get too excited about this one at the moment, to be honest. So what I've indicated on the chart here where I've done the circles is in September, it's tried to go through that June peak, but it's failed to do so. So I've circled the June peak, circled the peak in September. We can see it fell short. At the moment, it's back to a support level at $11. So to me, it's make or break. If it can rally strongly off $11, great, that's a buying opportunity. But I think if it breaks under 11, I'd be taking a very early loss and just waiting on the sidelines with this one.
Right. Okay, mate. Now these are the ones that our experts thought were worth selling. And of course, Michael, you're not influenced either way. The charts tell you what you see. Let's start with Blackmores.
Yeah, look, this one does look poor, and you're right, Peter. I mean, I turned up not knowing which ones were buys or sells, and this one does look like a sell. So what we saw was a nice rally in September. So the share price went back to the March lows, rallied strongly, but that horizontal line used to be support for Blackmores, but now it's clearly resistance. And we can see that it just couldn't push through that $70 level. It failed after a few attempts there a few weeks ago, and now it's clearly heading back at a great rate of knots. So I think there's a very good chance this one will be trading under $60 at some point in the next few weeks.
Okay, let's go to the next one. This is one that I wasn't too keen on. That was VUK, that Virgin Money stock.
Yeah, this one's also pretty poor. What I've indicated with that horizontal line was a very obvious support level. It broke that a couple of weeks ago, and it's just been struggling ever since. So the downtrend is back on for this stock, and I wouldn't be surprised if it heads under that March low also.
Okay, let's go to CPU, computer share.
Yeah, this one's a little bit neutral. It's sort of similar to that Lend-Lease chart where it failed to push beyond the June peak. So I've put a couple of horizontal lines here. So the top line indicates where it's failed to rally out of this range. But what it has done is it's gone back to the bottom of the range. It's trying to rally, but it's a bit, it's struggling. So I wouldn't discount it yet. I think that it has a chance to get back to the top of that range. But what I'd do is have my stop losses under that lower line, which is around that $12 mark. So I'd be holding on to it and see if it can rally. But if it breaks $12 very quickly, I'd be out of it. Okay,
let's go to AMP next.
Yeah, well, AMP, it's one big downtrend since day one, pretty much. What it looks like it wants to do is bounce a little bit more in the short term. So if I was looking to exit this, I'd be waiting for higher levels. So what I've indicated with the straight line here also is a level of support that it seems to have bounced off. We might see a bit of a short-term bounce, and then we might be able to get out at slightly higher levels. But at the end of the day, long-term, it is just in one big downtrend.
Okay, let's go to Tabcorp, TAH.
Yeah, this one also looks pretty weak at the moment. It's starting to roll over. What I've pulled up here is a longer-term chart, so going back about 6 years, just to indicate that even if this can rally in the short term, the horizontal lines show us a very serious level of resistance. So for about 5 years there, Tabcorp found a lot of support between about $4 and $4.20, and that will now act as very strong resistance. So if you're lucky enough to see this rally, I think the chances of it getting through $4 are very remote. It'll take a long time for it to get through that level.
Okay, mate. Well, as always, I appreciate your objective analysis. I always like to invest on the fundamentals and what your charts say. So thanks very much for your insights. Michael Gable from Fairmont Equities, thanks for joining us.
Thanks, Peter.
And that's the show for this week. If you want to know more about us, go and have a look at the Switzer Report. Go to switzerreport.com.au. We give a 21 free-day trial, and that way you can see what all our experts are thinking about the market, and they've really been on the money in recent times. In fact, they've been on the money for about 5 or 6 years. I'm Peter Switzer. Thanks for joining us.